Over $3 trillion in global market value evaporated in just weeks as AI stocks plunged, cryptocurrency markets crashed, and housing sales froze. The sell-off is spreading fast, and the question everyone is asking is whether this is just a correction or the beginning of something far bigger. In the next few minutes, we are going to break down the historical pattern that connects these three seemingly separate markets, reveal the one critical signal that suggests a major collapse may already be underway, and show you exactly where we are in the cycle that has repeated itself throughout financial history. Ever wondered if the frenzy around AI stocks, the wild swings of cryptocurrency, and the sky-high prices of real estate are somehow connected? It might seem like they are all in separate worlds, but what if I told you they are all part of the same massive, unfolding story? A story that has played out time and time again throughout history, leading to the greatest transfers of wealth ever seen. We are talking about a classic economic bubble, and the signs are everywhere, pointing to a pattern that looks eerily similar to 1929, the dot-com crash of 2000, and the financial crisis of 2008. In this video, we are going to break down this historical blueprint, stage by stage, and reveal the one critical signal that suggests a major shift could be underway. Stick around, because understanding this could be the key to navigating what comes next. Let us start with AI. We are in the midst of a full-blown AI tech stock mania. Companies with AI in their name are seeing their valuations soar to astronomical levels. The narrative is powerful. AI will change everything, from how we work to how we live. It is a belief in a completely new future, one that justifies paying almost any price for a piece of the action. Investors are pouring billions into companies that have barely turned a profit, betting on future dominance in a market that does not even fully exist yet. The excitement is palpable. Every earnings call, every product announcement, every new partnership sends stock prices shooting higher. Does this sound familiar? It should. This is the exact same psychology that fueled the dot-com bubble in the late 90s. Back then, any company with a com at the end of its name was golden. Investors poured money in, convinced that the internet was rewriting the rules of business. Profitability did not matter. What mattered was the story, the promise of infinite growth. Before that, it was the railroad mania of the 1840s. The belief was that railroads would connect the world and create unprecedented economic growth. Investors mortgaged their homes, sold their land, anything to get a piece of what they saw as the future. In every case, a revolutionary technology creates a wave of euphoria and speculative investment. The common thread is the story, the belief that this time it is different. But history shows us that while the technology changes, human psychology does not. The pattern repeats because we repeat it. Now, let us turn to cryptocurrency. For many, crypto is the ultimate modern speculative asset. We have seen incredible bull runs where people became millionaires overnight, followed by devastating crashes that wiped out fortunes just as quickly. This volatility is not a new phenomenon. It is a textbook example of a speculative frenzy, echoing some of the most famous bubbles in history. Think of the Dutch Tulip Mania in the 1600s, where a single tulip bulb could be worth more than a house. People traded their life savings for a flower bulb, convinced prices would only go up. Or the South Sea bubble in the 1700s, where shares in a company with questionable prospects skyrocketed based on pure hype and rumor. These events all follow predictable emotional stages. It starts with displacement, a new, exciting development that captures the public's imagination, like the invention of Bitcoin. This leads to a boom where prices start to rise, attracting more and more investors. Early adopters make money and their success stories spread. Then comes euphoria or mania, the point of maximum financial risk, where everyone is convinced they will get rich and caution is thrown to the wind. Social media lights up with success stories. People quit their jobs to trade full-time. We have seen this peak in crypto multiple times in 2017, in 2021, and in the cycles in between. But what always follows euphoria? Panic and the inevitable crash. The cycles in crypto are just a faster, more compressed version of a classic pattern. What took years in the past now happens in months. But the psychology is identical. Finally, let us talk about real estate. Unlike the digital worlds of AI and crypto, real estate is tangible. You can touch it, live in it, it feels safe, right? But the global housing market is deeply tied to something less tangible: debt and central bank policy. When central banks print money and keep interest rates artificially low, that cheap money has to go somewhere. It floods into the financial system looking for returns. Historically, it flows into hard assets first, and real estate is the prime target. This flood of cheap credit creates an illusion of ever-increasing value. It pushes prices up to levels that are completely disconnected from local wages and economic fundamentals. We saw this play out perfectly in the lead-up to the 2008 financial crisis. Easy money fueled a housing bubble that felt unstoppable until it was not. Homeowners became speculators, buying second and third properties with adjustable-rate mortgages they barely understood. The current situation in many markets feels like déjà vu. Prices are at record highs, affordability is at record lows, and it is all propped up by years of cheap debt. Young people cannot afford their first homes. Families are priced out of neighborhoods they grew up in. The foundation is shaky, and it is inextricably linked to the broader financial system. So how do these three seemingly separate markets, AI, crypto, and real estate, tie together? They are all symptoms of the same underlying condition, an excess of capital and credit in the global financial system searching for a return. This is the fuel for every bubble. When central banks keep rates near zero for years, money becomes cheap. Investors need somewhere to put it. They chase returns wherever they can find them. Tech stocks promise growth. Crypto promises revolution. Real estate promises safety. But they are all being inflated by the same source. This is not just a theory. It is a well-documented pattern known as the 7 stages of an asset bubble. Let us walk through it. Stage 1 is displacement, the new paradigm we talked about, like AI or blockchain technology. Something genuinely new and exciting appears. Stage 2 is the boom, as smart money starts investing. Early investors see the potential and move in quietly. Stage 3 is euphoria, when the media and the public jump in, prices go parabolic, and you hear stories of ordinary people getting rich. This is when your neighbor tells you about the fortune they made on some obscure token or tech stock. We have seen this in all 3 markets. Stage 4 is profit-taking, where insiders and smart investors begin to quietly sell their positions. They have made their money. They see the warning signs. They exit while prices are still high. Stage 5 is the key moment: panic. A single event or piece of news can trigger a massive sell-off. The illusion shatters, and everyone rushes for the exit at once. This leads to Stage 6, the crash, where prices plummet, fortunes evaporate. And finally, Stage 7 is despair, the long period of stagnation that follows, often referred to as a market winter. This is when the true believers hold on, hoping for a recovery that may take years. So where are we now? Many analysts believe we are in the late stages of this cycle. The euphoria in certain sectors has been undeniable. But the most crucial question is, has the profit-taking stage begun? Has the panic phase been triggered? The one signal that often proves the collapse has already begun is when the smart money starts to leave the market. These are the institutional investors, the corporate insiders, the ones who see the writing on the wall before anyone else. We are seeing subtle signs of this now. Insiders at major tech companies are selling shares at a record pace. The data is public if you know where to look. Big players in the crypto market have been consolidating their gains, moving funds off exchanges into cold storage or selling outright. And the real estate market is beginning to show cracks as interest rates rise, freezing transactions. Sales volumes are dropping. Homes are sitting on the market longer. These are not headline-grabbing crashes, but they are the tremors before the earthquake. The shift from euphoria to fear can happen in an instant. One bad jobs report. One bank failure. One geopolitical shock, that is all it takes. Understanding this historical blueprint is not about predicting the exact top or bottom of the market. That is a fool's errand. It is about recognizing the patterns of human behavior and risk. The greatest transfers of wealth happen during these massive shifts. When a bubble pops, wealth does not just disappear. It moves from those who bought at the top out of euphoria to those who were prepared, patient, and understood the underlying cycle. Being aware of the 7 stages gives you a map. It helps you control your emotions, whether it is the fear of missing out during the mania or the panic during the crash. It allows you to think critically and make decisions based on fundamentals and historical precedent, not just hype. In times like these, knowledge is not just power. It is protection. By seeing the connection between AI, crypto, and real estate, you are no longer looking at 3 separate puzzles, but at one big picture. And seeing that big picture is the first step toward navigating the incredible challenges and opportunities that lie ahead. Thank you so much for watching. I hope this breakdown gives you a new lens through which to view the markets. If you found this valuable, please give this video a thumbs up and consider subscribing for more deep dives into the economic forces shaping our world. Let me know your thoughts in the comments below. Do you think we are in a bubble? And where do you see the biggest risks? Stay curious, stay informed, and I will see you in the next video.